viewers, welcome to the Editorial Analysis by Drishti IAS. In this section, we regularly take editorials from various newspapers and news portals for a better understanding of various issues happening in India and around the globe. In this section, we first try to link our editorial with the UPSC syllabus. Then we go analytical in order to understand some key points and at last some important concepts. Dear viewers, we truly hope that you like this initiative taken by Drishti IAS. And your feedbacks are important for us. So kindly feel free to give your important feedbacks in the comment section. So without any further delay, let's commence our session.
Dear viewer, this video is available in Hindi as well. If you wish to watch it, please visit our Hindi YouTube channel, Drishti IAS. For your convenience, the link for this video in Hindi has been provided in the description below.
Today's editorial is taken from The Hindu, published on 3rd of December 2020. The title of today's editorial is Choppy Tidings. If we try to link today's editorial with our UPSC syllabus, we can link it with GS Paper 3, which has sections that include Indian economy, issues relating to planning, mobilization of resources, growth, development and employment, inclusive growth, issues arising from it, and government budgeting. If we try to summarize today's editorial, we can say that the government must do more for sectors that are employment intensive before the next budget. Some key points from today's editorial. Revenues from GST crossed the rupees 1 lakh crore mark for the second month in a row in November. The healthiest indirect tax collection streak since the national lockdown to combat COVID-19 in March. It is an encouraging sign for the economy that contracted less than expected in the second quarter. GST revenues in a month are a reflection of transaction from the previous month. Now, students, we all know that the GST revenue numbers, they have crossed the 1 lakh crore mark continuously for second time in 2 months. If we speak about the GST revenues, according to the Finance Ministry, the gross GST revenue that was collected in October 2020, it was around 1.05 lakh crores, and for the month of November, the figure has actually crossed 1 lakh crore. It can be said with reference to the data which we had in October 2020, where the GST revenue that was collected, it was 1.05 lakh crores. It was almost 10.25% higher than what it was in October 2019. Also, the revenue that was collected in October 2020 was 10.1% more than the revenue which was garnered in September 2020. Now, this can be seen as a very good sign because continuously in 2 months, we are seeing such an upsurge. Now, this upsurge actually came after the national lockdown that was put in the month of March to combat the COVID-19 situation. So definitely we can say that it is a very encouraging sign for the economy that has contracted less than it was expected in its second quarter. The uptick in October's GST collection can be partly explained by speedier unlocking of the economy in September as public transport restrictions were lifted in most part of India. Now, the reason, some of the people which have said that the reason why there was an increase in the month of October, the GST collections were quite high in the month of October because there was speedier unblocking. There was the unlock situation was completely applied to the country, and also the public transport restrictions which were put before that were actually lifted. So definitely that can be attributed as one of the factors why there was an increase in the GST revenue collection. Some compliance related relaxation for GST paying business also pushed up collections significantly. Now, some of the relaxations which were actually applied for filing up the GST etc. have also shown their results and the collections have increased significantly. There is no such compliance caveat attached to November's GST kitty, even though it is about 200 crores lower than 1,05,155 crore from October. If we speak about the November's data, we can say that in the month of November, the total GST revenue collection was around 1.03 lakh crore. It is almost 200 crores lesser than what it was in the month of October. However, we have to see that no such relaxations were applied with reference to the month of November. So even this achievement can be said as a great deal as of now. The present scenario, this suggests that the first month of the third quarter did see a genuine improvement in activity, whether it was by pent-up demand or by festive demand or a bit of both. So we can collectively say that there was an increase or a genuine improvement in the collections. Now it can be attributed to both the figures because of the festive season in India as well as because of the pent-up demand. Now what exactly pent-up demand is? Now pent-up demand is a situation when demand for a service or product is unusually strong. Okay, in such a situation, the economists generally use this term. Also, it should be noted that it actually means, if we speak about the literal meaning of the pent-up demand, that means people for a period of time have put a hold on their spendings because of any particular situation, like we saw in the case of lockdown. So people actually have stopped or they have kept a hold on their spendings. But the pent-up demand is a situation when people once again go back to the consumerism aptitude. You can say that a situation where people open up with their expenditures and we can observe an increase in the expenditure of the population. So such a situation is known as pent-up demand. This also ties in with other indicators from October, be it auto sales. Now we all know that there was a tremendous boost in the sale of both two-wheelers and four-wheelers vehicles. So auto sales, definitely they are doing very well. Or the purchasing managers index for manufacturing, which hit a 12-year high that month. See, these improvements can be attributed to various factors. Like I speak about the auto sales. So yes, auto sales, they have done their role, they have done their part, and it actually showed an increase. Also, the purchasing manager index. Now, what exactly purchasing manager index is? Now, if we speak about purchasing manager index, it basically is an indicator of business activity in the manufacturing and services sector. Now, how do you actually calculate the PMI? That is the Purchasing Managers Index. It is a survey-based measure that asks the respondents about changes in their perceptions about key business variables as compared to that of the previous month. It is calculated separately for manufacturing and services sector, and then a composite index is constructed. That means a survey individually will be done for the manufacturing sector as well as for the services sector. Then we combine both the data and we get the result in a composite form. So the PMI, if we speak about the PMI, so PMI basically is a number ranging from 0 to 100. PMI above 50, if the purchasing manager index score is above 50, it represents a situation of expansion, okay, when compared to that of the previous month. If the score in the index is above 50, we say that the situation in the economy is actually expanding with reference to both manufacturing and the services sector. PMI under 50 represents a contraction. A reading at 50, that means if the total PMI is 50, we say no changes have been observed. Now, what exactly is the purpose of PMI? The purpose is to provide information about current and future business conditions to company decision makers, analysts, and investors. As the official data on industrial output, manufacturing, and GDP growth comes much later, the PMI helps to make informed decision at an earlier stage. That means the PMI data, which actually comes month after month, is something which is provided to the people at an early stage. So it actually helps in that particular manner. Okay. So also, if you speak about the PMI for manufacturing, it is a 12-year high that month. That means with reference to the month of November, it was highest in the last 12 years. With Deepavali falling in November this year, Some festive spending effect may be expected to come through in December's GST collection as well. Now, because Diwali was in the month of November this year, so definitely the effect of the festive season can be observed even in the GST collections of the December month. However, the question is whether the improved demand trend will hold after the festival exuberance fades. Now, the biggest question before us is, once the festival season is over, now will this increase or will this improvement be on hold, or you can say, will this improvement be actually as same as it is in the month of October or November? We have to see how actually this performs after the festival season is over. There are some early signs that the fervor and pace of economic activity already began to moderate in November. Some of the people, some of the analysts, they have already observed this thing, that the signs of or the pace at which the economic activity was taking place, it has actually slowed down. Okay, it has actually moderated already in the month of November. So we have to see what happens later. For instance, Eway bills generated by GST covered entities fell nearly 14% to 55.3 million in November from 64.1 million in October. So see, if we speak about this contraction, okay, that we might observe one more time, once again, we can say that the Eway bills which were generated by GST covered entities, they have fallen down by 14% and they have come down to 55.3 million in the month of November, whereas for the month of October, this number was at 64.1 million. So we have to see such contraction. However, there is one important thing to know what exactly the Eway bills are. So if I speak about Eway bill, it is a compliance mechanism wherein by way of a digital interface, the person causing the movement of goods uploads the relevant information prior to the commencement of movement of goods and generates a e-bill on the GST portal. Now, an electronic waybill or the Eway bill system offers the technological framework to track intrastate as well as interstate movement of goods of value exceeding rupees 50,000. Okay, you have to remember this figure, 50,000, for sales beyond 10 kilometers in the GST regime. Okay, while the latest PMI indicates slower growths in order and a further decline in employment as businesses are wary of the pandemic's lingering uncertainty. Now we all know that there are various waves of corona. Okay, in some of the states in our country, we are already observing the third wave of corona. So yes, definitely, because of the uncertainties which are associated with COVID-19, there is again an issue based on employment, and we have to work upon that. The government has to see that this menace of unemployment is actually tackled in this duration. While India's infection have declined since September, some parts including Delhi, Rajasthan and Gujarat are seeing sharper spikes, promoting fresh travel curbs from there to the commercial capital, Mumbai. Now, we all know that the number of COVID cases, they are on a decline since the month of September. However, there are several states like Delhi, Rajasthan, Gujarat. We can see the third wave of corona working there. And because of such situation, there are some travel restrictions which have been put on the states of these people traveling to the commercial capital of the country, Mumbai. The future ahead. In November only, Andhra Pradesh, Gujarat, Tamil Nadu saw double-digit growth in GST collections among major states, while Delhi's inflow fell by 15% and Maharashtra by 6% year-on-year. Now, in the month of November, only three states, Andhra Pradesh, Gujarat and Tamil Nadu, their GST collections saw an increase, and that too in double digits. However, among major states, this was the situation of the three important states that I have told you. Whereas if we speak about Delhi and Maharashtra, their revenue has actually fallen down. Delhi has fallen down by 15% and Maharashtra has actually fallen down by 6%. Thus, economic activity that has resumed remains fragile while the recovery seen so far has been uneven across states thanks to the virus' unpredictable spread. Now, the biggest challenge is the unpredictability associated with COVID-19. And we have seen that because of this unpredictability, the economic activity situation, which appeared to be improving, has also got a bit of uncertainty because of the novel coronavirus. Okay. The government has been conservative so far in its stimulus and support measures, despite which its fiscal math for 2021 will go awry. More direct and specific measures to help employment intensive sectors, particularly those in distress such as travel and tourism or retail, are needed to ensure that further job losses today do not translate into tomorrow's demand slump. See, government has to take more direct and specific measures to help the employment intensive sectors, particularly whose their situation is not good. If we speak about travel and tourism industry and retail, their situation is really very bad as of now. So government has to take some very important measures such that the unemployment or the job losses, it does not happen. We have to be careful. If people are losing jobs at this point of time, it is going to be a very harmful for the economy in the later sections. We have to see that the job losses should be avoided so that the economy, which is even today, even now, it is not completely good. It is struggling. So we have to make sure that we first of all put our economy from the status of struggling to a stable one. So our first target has to be on this. So government is required to take all the measures that are required for the betterment of the economy as well as for the people of the country. So viewers, this was with today's editorial analysis. Now, the question that can be framed with reference to today's editorial is, in order to make a truly Atmanirbhar Bharat, the economic stimulus need to be complemented by bold reforms. Discuss in 250 words. So viewers, I hope you liked today's editorial analysis. Thank you very much.